Okay, so hello everyone, and welcome to day 4 of this ACCA webinar for paper AFM P4 Advanced Financial Management. We are starting just around 6 to 7 minutes later than scheduled because the attendance in the beginning was quite low. Therefore, I just took 6-7 minutes extra to start the class, and don't worry, we will make sure that this 6-7 minutes extra is compensated. Okay, now the first thing which we are going to cover today, although the topic for our day 4 is Black-Scholes option pricing theory, but the first thing we are going to discuss today is to refer towards our last class question. Okay, and from that last class question, we will firstly cover our last thing that is left, that is options. I will just give you a quick recap of that as well, and then we will move towards the new topic. You all have the question with you, and if you want to see the question on my screen, you can view it on my screen. If you want to see the question on the file which you have, which was shared yesterday, you can refer to that as well. So basically, the question was, Vertical was based in Eurozone. Okay, the company was based in Eurozone. It was in Euro. Okay. Assume it is now 1st October. I'm going towards the second paragraph just to make sure that we cover the important things because we have already read the question multiple times in the last class. So you needed to assume that today is 1st October 17. Treasury function has just received information about a future transaction by a newly acquired subsidiary in Euro, local currency the dinar. Subsidiary expects to receive the dinar 27 million on 31st January 18. And it wants this money to be invested, means deposited locally for 5 months until 30 June. Vardicol's treasury team is aware that economic conditions are currently uncertain. The central bank base rate, that is LIBOR, bank rate is 4.2. Treasury team believes it can invest funds at central bank rate less 30 basis points per 3%. However, treasury staff have seen predictions that central bank base rate could increase or decrease by 0.1 or 0.6 between now and 31st January. So there's always a risk that when you're investing money later, there's always a risk that rates may go up, rates may go down. Vardicol's treasury staff normally hedge interest rate exposure by using whichever of the following methods, that is FRAs, futures, and options. You were given information about local bank in your area with which Verdicol has not dealt before, has offered the following FRA rates: 4-9, 5.02, and 5-5. The treasury team has also obtained the following information about exchange traded dinar futures and options. 3-month futures are dinar 500,000 contract size. Prices are quoted at basis points at 100 minus percentage. December, March, June futures are given. Okay. Options data 500,000 contract size. Premiums are in percentage. There were 2 strike prices given: 94.25, 95.25, and you were given with the premiums for calls of 3 months and puts of 3 months. Okay. And then after the information, the question stated. Recommend a hedging strategy for 27 million investment based on hedging choices which company is considering. If interest rates increase by 1.1, decrease by 0.6, support your answer with discussion. So suppose that the company is considering three hedging choices. You need to recommend which is the best one if interest rates could increase or decrease. Okay. So we needed to decide to recommend the appropriate strategy if interest rates increase or decrease by 1.1 and 0.6. So I told you that in order to recommend which is the best one, we first need to solve all three and then decide. Okay. So first one we started was FRA. Now, before starting the question, I told you to incorporate four things with you. Okay. The case, the borrowing deposit date, today's date. Okay. And together with this, till what time we are borrowing or depositing, right? So today's date was 1st October 17, borrowing or deposit date was 31st January 2018 until when? 30th June 2018. And the case was of depositing. Okay, you started FRAs. Now, which FRA to choose? We said that today is 1st October. We plan to deposit on 31st Jan. That counts to 4 months. 1st October to 1st November, 1 month. 1st December, 2 months. 1st January, 3 months. And 31st January, 4 months. We need to borrow after 4 months or deposit after 4 months for 5 months. So the relevant FRA was 4x9. We took that 5.02% and then found the actual return on deposit and gain loss due to FRA. So return on deposit was the amount into rate of interest into time period over 12. Gain loss was the difference in what was the rate versus what was the FRA rate into time period over 12 into amount. Now gain loss, if the rates increased by 1.1 became 5.3, but you locked at 5.02, you were in loss. Loss should be deducted because it reduces return. We deducted it and got the answer. And if rates became decreased by 0.6, 3.6, and you locked at 5.02, that was gain. Gain increases return, added. The net answer of FRAs is always going to be same in both cases. Okay. Now the second issue was futures, which is a technical issue. So the first thing, which futures to opt. So we told you there are 7 steps. The first step was to find the number of contracts, amount over contract size into time period over 12. Okay, so we found 5 over 3, sorry, number of contracts as 90. Then basis rates, that is spot minus LIBOR, less futures price. Futures price were 3. Which one to opt? We need to borrow a deposit on 31st Jan. We don't have January future available. We will take the next one, March. Okay, then unused basis risk into extra months. So for 31st January, you took 30th March contract, 2 extra months over total months for 6. Then future closeout price in both cases. The first case was increased by 1.1, second case was decreased by 0.6. So spot minus LIBOR. In increased case, it was spot minus LIBOR, increased by 1.1, 5.3, and in decreased by 0.6, it was 3.6. Less futures price, that was, less unused basis, you got future closeout price in both cases. Then you found tick. If it is not given, tick was not given, we found it. And after tick, that was the outcome of hedge in both cases, increased by 1.1, decreased by 1.6. We wrote actual return on deposit like C, and gain loss due to futures. So difference in futures price and the closeout price. Futures price was given, closeout price was given, and the strategy in deposit was buy now, sell it. Into spot, into contracts, into tick, we got the gain loss. The answer of futures is also going to be the same in both cases. Okay, increase as well as decrease. And the last thing was interest rate options. Okay. Now, as far as the interest rate options are concerned, I told you options have a format as well. First one was make heading of 2 cases, increase by 1.1%. Okay. And then decrease by 0.6%. Okay. was a 7-step or 8-step approach. The first was to note the exercise price of options compared to future closeout price, which should come from futures exercise yes, no. Fourth, gain in basis points. If yes, obviously if it's gain, then only it's yes. Then it's total gain, actual cost of borrowing or actual return on deposit. This was the case of deposit. So actual return on deposit from futures. Finally, premium payable. You get the net cost or net return. Net return. And finally, the effective interest rate. Okay. Okay, so let's start. Now, if you open the question, exercise price of options. So remember, we did we have to do on 2 exercise prices because 2 exercise prices are given. So we already did the first one in the last class. So we will discuss the second one. What is the exercise price of option? The second one, it's 95.25. So I will firstly write 95.25. Okay, this is the exercise price of options, 95.25. Now you need to compare it with futures closeout price from futures. So we already computed futures closeout price in futures. So let's see what is the future closeout price in futures. So in case of increase, I think it was 94.36. And in case of decrease, it was 96.06. Okay. Yeah, I need to decide exercise yes. Now the strategy was buy now, sell later. Remember, buy at this price, sell at this price. So buy now at 95.25, sell at 94.36. Buy at 95, sell at 94. Exercise yes or no? The answer should be no. Okay, but the strategy is buy now, sell later. So buy at 95.25, sell at 96.06. Okay, so this is going to be a gain. So yes. So next, gain in basis points if yes. So this is not yes, so 0. This is yes, so you can take the difference. It's 0.81%, so 0.81% means 81 basis points. 0.81% means 81 basis points, okay? Then the total gain. It's the gain in basis points into number of contracts into tick. So gain in basis points into number of contracts into tick. This makes it 0 because there is no gain. And this makes it 91125. Okay, then actual return on deposit or actual cost of borrowing from futures. So actual return on deposit from futures was increased by 1.1%, 560 to 500. And decreased by 6%, 371 250. Okay. Now finally the premium payable. So premium rate into spot into number of contracts into tick. That's what premium is basically calculated as, premium rate into contracts into spot into tick. So what is the premium rate? We have taken the second exercise price, right? 95.25. So do you take a call option or a put option? In deposit, you take a call option. So only calls are relevant. And December, March, June, you have already selected the March one. So March premium is 0.09. March premium is 0.098. So it's a 0.098 into spot 100 into contracts 90 into tick 12.5. So the premium is going to be 0.098 into 100 to 90, 12.5, 11025. Okay. So you will get the net return on net cost. So premium, it has to be paid, which reduces return. Therefore, I will deduct it. Double 51475. And premium has to be paid, reduces return, deducted, but gain increases return, therefore added. So finally, 371250 minus 11025 plus 91125. It's 451350. Now there should be a flurry of questions that you told us that both options always give the same answer. Okay, that's why I prolonged this topic to today's class as well. In forward exchange contract, the answers of both will definitely be same. There is no exception. In futures, the answers of increase decrease will also be same, but in options, the answers can be same as well as different. Okay. In the first exercise price, it was same because both options were yes, yes. But here, one option is yes, one is no, as you can see. So answers can be different. And you can find the effective rate by the net divided by amount into 12/5. So the effective interest rates of both options are 4.01%, And here the effective rate is 4.9%. Okay, now you have effective rates of all techniques. Which is the best one? Remember, when you are borrowing, the case is borrowing, you select the one which is offering the lowest effective rate percentage. But in case of deposit, we will select the one offering highest rate percentage, and whichever is the highest, that will be selected among all three techniques. Okay, this sums up our interest rate risk management. You can note that, and shortly we will start our Black-Scholes option pricing theory after taking your questions if you have. Thank God, Bharti, after 7 messages, you finally realized your calculation mistake. Anyways, Anatoly, there are multiple approaches, but my approach is in currencies, we follow lock-in rate strategy, while in interest, we follow the basis strategy. Moin MD, this is a question which is asked by many students. I don't know, there might be some people who have studied like this, that only one exercise price working is required. No, you can see the market scheme, both exercise price working is required. Mukhtar, because you hedge yourself against fall and gain both. So no matter whether rates are rising or falling, your amount is fixed. That's why they match. Keshav Nageshwar, the actual return on deposit is directly copied from futures. It's spot. Shalima, you can just WhatsApp me your query because I don't know what it is mentioned in the discussion, and I will see the discussion and let you know. Kritika, we are following a standard pattern. So obviously, if we enter into any area of different from the standard pattern, then we have to compromise some other area. So obviously, if we continue with some other techniques or this interest rate risk management today, then obviously we are just left with one day. Either we have to do Black-Scholes or mergers. Both won't be possible to get covered in a single day. Therefore, we have to start options, and you can refer to a message me in private on my WhatsApp to find a solution for your extra queries. Okay, so our today's topic is option pricing theory, also called Black-Scholes option pricing theory, also called option pricing theory by Black-Scholes. Okay. Jagat Rajpakse, in that case, Shoaib Assam, can you please just WhatsApp your number here? I will check. Jagat Rajpakse, sorry, your question remains unanswered. How do we get the futures closing if only options method is tested? That's a very good question now. From Jagat, and I'm discussing this question because I think everyone of you should know this, right? Now the student is asking, how do we get the futures closing price if only options method is being tested? Remember, in the format of options, there are two areas where we say, okay, write futures closer price from futures, actual return on deposit from futures. So he's asking, what if futures is not tested in the paper? Only options is tested. So what do we do? In that case, you have to find the future closer price, that is step 4 of futures, under any circumstances. Even though future is not tested, but still you need future closer price for options. That's why you need to do futures working till step 4 definitely. Okay. Now, Bharati, your question doesn't make sense here. Can I use this borrowing put option, but if contract size is in different currency? That's not possible because the currency issue only arises in currency risk management. In interest rate risk management, there is no issue of currency. You need to borrow or deposit. So obviously you will borrow or deposit in your country. So the countries don't shift in interest rate risk management. So that is not a possible question which even happens in real world. Soheb, I haven't received any text of yours on my number. So once you will send me your number, then I will send you the group link. I haven't received any WhatsApp text from you, or you are not sending from this number. Okay, so let's move towards the next topic for today. That is option pricing theory, also called option pricing theory by Black-Scholes. Okay. Now, before starting and rushing towards the computations area, okay, this is an option pricing theory. So let me give you some introductory information about what exactly is an option. Okay, what exactly is an option? Let me just tell you what exactly an option is, and then we can move towards this option pricing theory. Now, let's suppose you want to invest in shares. For example, you want to invest in shares. You bought 1,000 shares of a company at $2. Please pay attention. For example, you want to invest in shares. You have made up your mind that I will invest some money, so you decided to invest in shares. You bought 1,000 shares of a company at $2. Now let's suppose the share prices start moving up. Will you get a gain? Yes, and you will be happy. But what if the share prices start moving down? You will start suffering loss and you won't be happy. You may want to back off from this arrangement, but you can't back off because you have already bought the shares. They're in your account. So if you want to back off, you can't because the shares have arrived in your account. Now, if you have to back off, sell it, incur loss, and then go away. You cannot back off from this deal. Okay. Similarly, let's suppose you already have 1,000 shares of a company which you plan to sell. You already have 1,000 shares of a company which you plan to sell. Now let's suppose you sold 1,000 shares for $5. You sold these 1,000 shares for $5. And the next day you start witnessing that the market prices became 6, 7, 8, 9, and you just or your mind stops working that what mistake did I make? I sold my 1,000 shares for $5 and the prices became 6, 7, 8, 9. Had I waited, I would have had more gain, but I sold them and now the prices start increasing. There is no point in backing off from this deal because you have already sold shares. You can't back off. Now that means if a person buys shares and the prices start going down, there is no option of back off because he has already bought shares. Similarly, if a person sells his shares and suddenly the prices start moving up, he cannot back off. He cannot do anything because he already sold. So to protect investors' interest, there is an other type of opportunity in the market which is called options. It has a complete separate market, the options market. In options market, if you want to invest in shares, you don't buy 1,000 shares at $2. You only acquire a right to buy 1,000 shares at $2. You don't buy shares. You only acquire right to buy 1,000 shares at $2. And you know under what conditions? You didn't buy shares. You only got the right to buy 1,000 shares at $2. Promise, right to buy shares at 1,000 shares at $2. On the condition that if prices start moving up, became 2.3, 2.4, 2.5, 3, 4, 5, the prices start moving up. I acquired right to buy 1,000 shares at $2. Not, I didn't buy shares. I only bought right to buy 1,000 shares at $2. If the prices became 3, 4, 5, I will exercise my right to buy 1,000 shares at $2. Exercise my right, get these shares for $2, and then sell it for 3, 4, 5 in the open market and earn heavy gain. And the condition is that if the prices start going down, 1.5, 1.4, and I start incurring loss, I will back off from this deal. So see how much investor is protected here. If he just goes randomly in the market and buys 1,000 shares, there is no U-turn. He has bought shares. Now, if the prices go down, he will definitely suffer loss. But if he just takes a right to buy shares at $2, he's protected so much that if the prices start going up, he will exercise his right to buy 1,000 shares at $2, get 1,000 shares at $2, sell it for 3, 4, or 5 in the open market and earn gain. But if the prices starts going down, he will back off from this deal. Similarly, let's suppose you already have 1,000 shares you plan to sell. For example, you have 1,000 shares and you plan to sell. If you sold these shares and the prices starts going up, you will suffer loss. Okay. Go in options market. Go in options market. You have 1,000 shares which you plan to sell. Don't sell the shares. Just acquire right or promise to sell 1,000 shares at $5. You didn't sell shares. You didn't sell shares. You just got a right to sell shares at $5 on the conditions that it's a right, not an obligation. That if the price starts going down 4, 3, 2, I have already acquired right to sell 1,000 shares at $5. I will exercise my right and sell shares at $5. Sell the promise at $5 because the prices have starts going down. I already got a right to sell shares at 5. The prices are going down. I will exercise my right and sell shares at 5. But if the price starts going up, $6, $7, You just acquired right to sell shares at 5, but now the shares are going in the market at a higher price. You back off. Leave the right and go in the open market and sell it for $67. So see how much investors are protected here. You are selling, you're acquiring a right to sell shares. If the prices go up, you just back off. Don't sell your shares at 5, sell it for 6 or 7. Sir, is this only in shares market? This is in every market. Okay. You can consider the example of Forex market. Let's suppose in Pakistan, the currency is PKR and the dollar rate to PKR is PKR 160. Dollar rate to PKR is PKR 160. Okay. Now, for example, I have decided to invest in US dollars and I've decided to buy $1,000 at 160. I've decided to invest in US dollars and I bought $1,000 at 160. Now let's suppose prices starts going down 158, 157. I will be in loss. There, the protection is options market. Don't buy $1,000. Just acquire a right to buy $1,000 at 160. What are the conditions of the right? You just got a right to buy $1,000 at 160. On the conditions that if prices go up 162, 163, 164, I will exercise my right to buy 1,000 at 160. But if the prices go down 155, 156, I already got the right to buy $1,000 at 160. Now the prices have fallen, I will back off. This is options. Let's suppose you already have 1,000 shares. Okay. And you plan, let's suppose you already have $1,000. You plan to sell. If you sold and the prices go up, you will suffer loss. Just acquire right to sell shares or right to sell dollars at 160. On the condition that if prices go down, I will exercise my right and sell for 160. But if the prices go up in the market, I will be selling it for 160 163. I will back off. Now, if the investor is offered so much protection that, okay, don't buy 1,000 shares, don't sell 1,000 shares, just take a promise to buy shares at 5, sell shares at 5. If the prices go in your favor, exercise the right, and if the prices go in your favor, sorry, that you bought 1,000 shares and the prices starts going down, exercise the right and take at 5. And if the price starts going down, back off. Similarly, if you bought, if you decided to sell some shares, don't sell shares. Get a right to sell shares at 10. If the prices go up, back off. If the prices go down, exercise it. Now, if the investor is offered so much protection, that won't be for free. Correct. When you enter into options, options is giving you so much security that you get a right to buy shares at 10. If the prices go up, you exercise your right, get it for 10. But if the prices go down, you back off. So if you enter into options market, that's not for free. You have to pay a small premium while entering into options market. You have to pay a small premium. How this premium is computed? This is computed through a theory called Black-Scholes option pricing theory. So the purpose of Black-Scholes option pricing theory is just to find the value of options. How much premium we should pay when entering into options. This basically is computed by Black-Scholes. Okay, any questions up till now? Yes, Femida, you won't enter it for free, you have to pay premium. Yes, Ayuni, the basic purpose of option is to protect investor from loss. Like if you just directly buy shares and you directly sell shares. If you directly buy shares and sell shares, there is no U-turn. Buy shares means if the prices go down, you have to bear loss. Sell shares at 10 and the prices go up, there is loss. But if you enter into options, just take a promise to buy or sell. And if the prices are going against you, exercise your right, get it for 10. If the prices are going up and you're still getting for 10. If you are getting a right to sell for 10 and the prices go down, exercise and sell it for 10. But if the prices are in your favor, if the prices are going down, you can back off. Yes, Abid, value of options is the value of premium. Mohammed Afzal, I don't know how much area I will be able to cover today, but to make sure and you can be completely satisfied on this, that we will try to cover as much detail and options as we can. Now, Safar Rahim, your question is interesting. How the option seller makes a profit. Now, basically, this is a game of two like-minded parties who both are willing to enter into options without any obligation, so that both can back off. Okay, but their reading is different. Like, for example, you have seen that, for example, you want to buy a property. Okay, you want to buy a property. You see that the seller is asking for $10,000. For example, the seller is asking $10,000 and you give him offer of $6,000, and suddenly the deal gets locked at $8,000. The person who is selling, he thinks that $8,000 is a good price. I won't get higher than that. Okay, but the buyer considers 8,000 as a cheap price. So the mind reading is different. That's why the deal is locked. Similarly, if I am going to the option seller and he's giving me a right and offering me protection, he is thinking that the prices will go in his favor, whereas I think prices will go in my favor. But I can back off anytime and my premium will be lost. So still, he will still gain from the premium. Yes, Hazik, if you don't exercise the option, you just back off, you have to leave the premium. And it's quite good because it protects you from the risk. Now, just a thought came in my mind that options are so much incorporated in our real life. Options are so much incorporated in our real life that even if you travel, the airlines have started using this option pricing theory. Airlines have started using this option pricing theory. Just this thought came in my mind that airlines have also started using this option pricing theory. Remember, for example, you want to travel from Pakistan to, let's suppose, UK. You want to travel from Pakistan to UK. And let's suppose you checked the dates at an airline website. The fares were coming, let's suppose, $800. The fares were $800. That's a very common issue with the travelers. Let's suppose you buy the ticket for $800. Okay. And after 3 or 4 days, when you again check the fares, you are getting the ticket for $600. So what did I do? I should have been more patient. I just bought the ticket for $800 and the next day I'm getting it for $600. That's for loss. Next time you decided to be patient, you didn't book the ticket right till the end, and suddenly the fares became $1,000, $1,500. So what did I do? So airlines have started giving you one thing. Let's suppose you are getting a ticket for $800. You're getting a ticket for $800. There's always a chance that ticket prices may go up if you buy here and the prices go up, but if you buy and the prices go down, there's always a risk. So airlines say, okay, don't buy the ticket. Just buy option to get ticket for $800. Don't buy the physical ticket, just buy option to get ticket for $800. What are the conditions? If after a few days the prices go to 900, 1000, 1100, you still have the option to the promise to get the ticket for 800. Even though prices are 900, 1000, 1100, you will still be eligible to buy the ticket for 800. Protected. But let's suppose after a few days you got the option to get the ticket for $800 and the prices became 500. You're getting it at a cheaper price. You promised to take it for 800. Back off. Will the airline give this protection for free? No. You can check the website. Airline charges a small premium from you, $20, $30 of entering into option, because it is protecting you. Protecting you. That if the prices go down, you can back off and buy at a cheaper price. And as prices go up, you still will be able to get for 800. Naseem Khan, any party like exchanges. Nesper, please be more specific. There are 3 examples in front of you. One is dollars, one is Forex, and one is airlines. So which example you are talking about? Okay, so I said that let's suppose we want to travel from Pakistan to UK and we checked the fare on the airline's website. The fare was $800. I bought the ticket. Suddenly, after a few days, I again checked the fare. I was getting the same ticket for $600. So I said, okay, what did I do? What the hell mistake I made? I should have waited. So airlines give you now the opportunity. Don't buy the ticket for $800. Just take an option to get ticket for $800. Option to get ticket for $800. The condition is that if the prices go up, become $1,000, $1,100, $1,200, you still have the option to get the ticket for $800. Exercise the option, get it for $800. But if the tickets fall to $500 or $600, you promised it to get it for $800, but you're getting it at a cheaper price. Back off from the option. So they won't give you this protection for free. They charge a premium. How this premium is computed? This premium is computed through Black-Scholes option pricing theory. So that means the basic purpose of Black-Scholes option pricing theory is to calculate the premium. The basic purpose of Black-Scholes option pricing theory is to find the premium. Okay. Now in real market, there are two types of options. If you want an option or right to buy something, this is called call option. Okay. And if you are taking option or right to sell something, this is called a put option. Right? If you want to buy shares, buy forex currency, the US dollars. If you want to buy anything, if you buy and the prices go down, you're in loss. If you take a right to buy anything, this is called a call option. If you have already got that thing and you plan to sell, if you sell and the prices go up, you can't do anything. If you just take a right to sell, that's called a put option. Now, some options are called American style options, and some options are called European style options. Okay. Some options available are called American style options, and some are called European style options. Okay. The only difference between these two is that both give a right protection to the investor. They have a flexible expiry date. European style options have a fixed expiry date. Okay. Like for example, someone is giving you option, a right to buy or sell something. That option won't last forever. It would have some time period, 2 months, 3 months, 6 months, 8 months, 1 year. American style options have a flexible expiry date. Okay, the date is 2 months. It expires in 2 months, but we can settle anything earlier as well. Whereas European style options have a fixed expiry date. 2 months means it would be exercised right at the end of 2 months. Okay. BSOP, this Black-Scholes option pricing theory which we're covering, is only dealing with European style options. American style options which have flexible date, they are not a part of your sales. Okay.